Yeah, thank you. All right, and we're going to record this for everyone. So if in case anyone that's on the call here wants to hear it again or share it with their peers, this is what we're here for. Thank you so much, everyone. My name is Anastasia Bonholtzer. I am a mortgage advisor with AMS Mortgage Services, and I am one of the affiliates in action with the Palos Verdes Association of Realtors, and we are doing Food for Thought. And today I am so honored and blessed to share with you my credit reporting guru, Vic. I have a little bio for you, Vic, so if you don't mind, I'm going to go ahead and get into it.
Sure.
To beef you up even more here. So Vic Melillo has over 40 years of credit reporting industry experience, starting from when he pulled his first credit report at the age of 12 years old. He then went on to co-owning and now operating a national credit report agency. Vic has provided credit reports, credit scores, and all services lenders need for decision-making to close loans. Services are provided to banks, mortgage bankers, mortgage brokers, housing, counseling, home buyer agencies, and real estate professionals nationwide. And he is here with Premium Credit Bureau. So hello. Thank you. So we're gonna go ahead and Vic,
Yes.
tell me why 12 years old? Like, why? I'm actually really curious on your bio. Like, how did you even get into that at 12 years old? It's the last thing a
it
12-year-old
was
may be thinking about, right?
no. It's funny. I tell most about that, and nobody actually has ever asked and said, like, enlighten me a little bit about 12 years old. What were you doing? So it was summertime, middle school, and it was a mother uncle running a company back in the day called Eastern Credit Research, and I just went in there, and they said, "What are you going to do?" And this was back in the refi boom of the 80s. And, there I was. I had two jobs. One was Louis the Locator. I had to find the credit reports because in those days, you actually mailed in the 1003. It was manually typed and we mailed you back a credit report. So Louis the Locator, finding the files that had to go out in the mail that day, and then pulling those credit reports so the typist could type the information and get it to you.
That's fantastic. I imagine no 14-day closings back then, right? Takes
Right.
a little
Right.
long. All right. So we'll get right into it. I have a few questions for you. So how are credit challenged clients affecting your closings, and what are the most credit hurdles in real estate? So I come across this a lot. I have clients come to me say, you know what, I'm not ready to buy a home because my credit is bad. And then, essentially what is bad and how can we get a client to commit faster to us in the process without waiting? So how do we eliminate the wait game with people who think their credit is bad?
Yeah, no, absolutely. So, that weight game of, you have the person that says their credit is bad, and then you wind up pulling it and finding out it's good. And then the person that says their credit is great, you wind up pulling it and their credit is bad, for them. But, it's taking that guessing game out today. And especially within the real estate market, there's many areas people can get their credit report. So if somebody comes to you and says, my credit's bad, I don't think I could afford a home. Where did you get that credit report from? What are you looking at? Because, there's so many different sites to access your credit. How do they know what's good or bad with regards to the credit and the score? And that's where Anastasia plays a vital role, is, giving them the ability to see the actual credit report and, more importantly, see the actual mortgage credit score, which I'm sure we'll get into a bit later.
Yeah, no, I love that. So when you mean where did they get it from, a lot of the clients are like, well, I go to Credit Karma and my credit is 750.
Right.
And then I pull their credit and I'm like, hey, buddy, you're barely at 620 over here. So why is there such a significant difference between Credit Karma and what mortgage lenders use for credit?
No, and you know what? It's imperative for you to implore that difference and give them that knowledge of what the differences are, because what's the typical consumer to think? Oh, Anastasia, you're saying my score is lower, so you could charge me more, right? I know you're not, but that's the impression people get, and giving them the right education that going to Credit Karma or looking at your Discover Card statement and seeing your score there and then wondering why. And it's not just Anastasia, let's just say, right? It's not AMS Mortgage's credit score. It's not Premium Credit Bureau score. These are the scores and information nationwide. But when a lender is pulling it, they're using the lender score models deemed and required by Fannie Mae and Freddie Mac. And when they're going out in the world of credit, especially Credit Karma, there's different scoring models. So everybody's using the FICO score now. They're giving a Vantage score in a lot of cases. And if it is a FICO score, they're giving a different version of FICO. So seatbelt on, everybody, but we're utilizing the score models from 2004 and 2005, okay? And that's the models they've been using. There's a buzz, change is imminent. We will get up to the FICO 10 scoring model, but I think there's 13 or 14 different active scoring models right now.
That's
So again, we're on the 4 or
when you
5
said that,
version,
yeah,
and
when you,
most online products will give you the FICO 8 version.
yeah.
And when the change gets implemented, possibly late next year, we'll be utilizing the FICO 10 model. So avoid any disappointment by having the true mortgage score provided by the mortgage lender.
And what is the difference between the different FICO, from 5 to 10? What are the changes? Is it how different credit is impacted? Is it, if somebody has one late payment, it's heavily weighted more than another one? Is it, what's the difference between the different models that are out there?
Sure. So the key difference right now is they feel that they are expanding the opportunity of borrowers with a better reflection in the score. So with the 04, 05 models, you may have seen this, but whether you had a little medical collection or bill you didn't know about, whether it was $11 or $1,100, it could drop your credit scores in the area of 100 points for a newly reported collection account on your report. So it's going to take a little bit of that ridiculousness out, let's say in the FICO 10 model that, Vic Melillo or Anastasia, who has a 730 credit score. I'm just surmising, Anastasia, I'm sure you're much higher. But, it's not going to destroy your score if there's a $15 or $20 collection account as it could have previously. So it's supposed to expand things. One key thing is it said it's going to start, factoring in more the non-traditional payments of possibly rent and utilities. But again, even today, I'm not a big supporter of the rent and the utilities being something included in your credit profile rather than just your traditional, revolving credit loan type of credit situations.
Yeah, I agree with you. So, how do scores shape mortgage approvals and rates? I can kind of touch base on that a little bit. For obvious reasons, the lower the credit, the higher the interest rate. But we do have some products which you can go down as low as 500, for an FHA 10% down. From your perspective, what do you see? What correlation is there between score and approval, mortgage approval?
Right. So, digging in on what actually is that score, right? That score is a risk factor. Or, when I do a lot of my seminars, I like to say a credit score is kind of like a reputation, right? So, when we're looking at someone's reputation, where do we get that information from? And how do we judge the character of Victor or Anastasia to say whether they're good people or not, in a sense? So they're putting a little number here about your ability to repay this loan, the likelihood that you will make your first mortgage payment and continue to make the remainder of those payments. So, again, having a higher score means you're a less risky person to borrow from. And then having that lower score obviously is going to come with what, Anastasia? You know the area there. I don't want to call it penalties, but there's going to be add-ons, that the person that wants to lend you that several $100,000 for the home is going to assume extra risk. Why? They're going to charge you more.
Right, exactly. And that's the advantage of going with a mortgage broker, is because we do have those alternative mortgage products in which lower FICO score individuals, or maybe somebody's even, not necessarily on purpose ruin their credit, but going through a divorce can be a really problematic thing. And as a certified divorce lender, I see that quite a bit. Somebody can have a perfect FICO, and then the divorce process and trying to split up the debts and the assets causes, definitely negative impacts on the credit score. And, if they go, for instance, to a bank to get credit approval or mortgage loan approval, they're going to get denied because banks have very strict guidelines as to they want their 720 FICO score individual, maybe probably no lower than 660. And if you don't fill that bucket, that's it. You might as well just close shop, never be a homeowner again. And if you come to me, at least we get you into the home. So then at least, get into the home, work on your credit, then always refinance for a lower credit score.
And Anastasia, you brought up something great because you mentioned divorce, and that is a little niche that you're working in. And I think for everyone on the call, that's kind of like what we're trying to give to you today is extra verbal power, which will do what? Attract more people to want to talk to you. How do you separate yourself from the other realtors? How does Anastasia separate herself from the other mortgage brokers? And again, it's just letting people know that you have information or resources. You don't have to know everything, but Anastasia doesn't know everything about credit. I don't know everything about mortgages, but we'll rely upon each other to find the right information to help that person. But divorce, for everyone on the call, one key aspect is do not think that divorce decree is all protecting for all credit, meaning when they separate and part ways, because the divorce decree says he or she is responsible for this debt, you could still have an obligation to the creditor who's reporting information to the bureaus. So if we're joint on a card, say Anastasia and I need to know that account is closed. And now I have my own account in my own name, and she has her account in her own name. Because if we're still commingled, there's damage that could be done with regards to the credit report.
Yeah, that's a good point. I mean, I give a lot of couples in that situation advice in which if you have joint credit accounts and the judge is now terminating those accounts, guess what? Now you have no accounts. So you have to open up new credit lines, which negatively impact your credit because now you have newer accounts as opposed to having a 20-year-old account that was joint from your marital experience.
Super point, Anastasia, because you need that, history
Right.
for yourself, because credit scores know what? Nothing about how much money you make or how much you have in the bank. They just know who and how you're paying people, and you got to have that who, how, and the longer you have an account for, the more strength it is that I've had and maintained and paid, and I'm showing strength, where newly opened accounts take time to season and rebuild that reputation of your ability to repay.
Yeah. So now going into another topic. So obviously everybody wants perfect credit. Like who doesn't? But life happens. We all go through credit challenge situations, whether high credit card utilization, whether it's divorce, one late payment, whatever it is. How can real estate agents help clients boost their credit score and correct specifically inaccuracies? Let's say I pulled a credit and I'm like, hey, you have 10 late scores here. What can we do to help the realtors in this situation to correct and to mitigate those inaccuracies?
Good. So you're basically tapping on what are some good general pointers that you could share to an individual that's saying, I think I want to buy a home, or I want you to, I'm thinking about a mortgage for themselves. So, the first thing is to ask, do they have open and active credit? Because the stronger scores come from those that are maintaining at least 4 to 5 active accounts, and a good portion of them being revolving accounts, which will contribute more to stronger scores. So again, what is your what do you call it, story about yourself? Because that's what a credit report is, a 7-year story about you. The authors are the creditors, and the library is Experian, TransUnion, and Equifax. So make sure they have open and active credit. Then ask them, how are the balances you're carrying? Optimally keep balances at less than 50% of the credit limits. You can raise those balances, obviously, at particular times, but when I'm thinking about financing and someone looking at my credit, I want to know that those balances are below 50%, or to really maximize scores, keep tiny tickling balances. Also, don't be the person that charges on a credit card and then goes home and pays that balance. Because what gets reported to the bureaus is what your credit card statements come in at. So if they're always coming in at zero, they really never know that you used that credit. So you do need to leave balances on cards to report, and then after the statement is generated, hopefully pay that balance in full to keep that activity. If you had a delinquency, you want to try and make it to last. So what you're looking to do is create what I call a window of non-delinquency. And the longer that window is, the stronger your score will become for yourself. We may hit a bump in the road here or there, but we have to ensure we're not hitting continued bumps. And to me today, there's almost no reason to have a missed payment on a credit card, because the beauty today is to do what?
Auto pay.
Auto pay, just for the minimum. So if you have, pardon the French, a brain fart and you don't pay your bill, it's automatically going to be paid for the minimum. And then you could always go back and pay more, but just giving them some of those helpful tips. And then if they have the ability to review the report and see an inaccuracy or something on it, do not do a frivolous dispute. Okay. So it's the beware of credit repair, beware of debt consolidation companies, debt counseling companies, because I see a lot of people getting grabbed into those thinking it's the solve all, fresh start that they're looking for, and it winds up doing more harm than good for themselves. So, in reality, the best avenue is get a report pulled by a professional like Anastasia, and then seek the advice of individuals that have read credit reports since they're 12 years old, or has done mortgages, for such a long time, because there are rules that apply to all. And then there's different situations. People ask about closing accounts. I say do not close any accounts unless we're advising you to do so. Because like Anastasia tipped on earlier, you might say, I don't like this card. It's, giving me a $50 annual fee. But that's the only account that you've had open for 10 plus years. That might be the major contributor to your strong score. And you don't want to take that away by closing that account.
Yeah, that's a good point. I mean, what I've seen is some savvy individuals, they don't know how credit works, right? They pay off the balances, there is no balance, and then they wonder why their credit score is 680. When I pull all of their accounts, they have no revolving credit. They have, they may have active lines of credit, they may be one or two. And so having very little active revolving credit cards is what leads to a lower credit score, in my opinion. So Vic, what can we do for clients? Let's say I have a client that comes in and says, you know what? I don't want to work with you because my credit's going to be pulled and then you're going to ruin me for life. And then it's going to drop 50 points. And then it's like, I'm never going to recover from the experience of getting a pre-approval with you.
Right.
What is the myth behind lenders pulling credit? And
I
how
love it. Yeah, and you're hitting on the number one topic, the fear of the credit inquiry. And there's a huge misconception behind that fear of the credit inquiry. And that's what Anastasia's talking about, everyone, is the inquiry is the protective measure that no one's credit report has been accessed without their permission. So there's that record of the inquiry. How can the inquiry work against you is the fact that an inquiry is what? You're asking for money. So if you ask too many people for money, you look risky. I love my corny analogy, but if I'm on the call right now and we were live and I said, look, I lost my wallet or I left it home. I want to buy lunch today. Mindy, can I borrow $10 for lunch today? Oh, sure. Vic seems like a nice guy. And then I go to Jose and I say, Jose, can I borrow $10? And he's like kind of wondering, well, why does Vic need another $10? And then I ask Anastasia and she says, you're crazy. You already got $20. You're never going to pay us back. Well, that's where the inquiry could build as a negative for you, asking too many people for money. What if you get money from all of them? Do you have the ability to repay it? Now, no single inquiry ever ruins a score. If an inquiry impacts a score, it's 2 to 5 points. And that's on a hard inquiry. Anastasia has access to soft inquiries, which have zero impact to your score and zero ability, which we'll get into later, of marketing and trigger leads. And we'll talk about that. But staying on the home point here of, does an inquiry ruin a score? Never. And the only misconception people have about, Anastasia, you pulled my credit report and ruined it, their score was always a 653 that Anastasia pulled. They got it from Credit Karma, which falsely used it, not falsely, but used a different scoring model, leading them to believe it was a 693. Or the last time they pulled their credit was 2 months ago. And now summertime has hit and they bought a new grill and they bought a vacation and their credit card balances went up so high. So that did drop their scores for themselves. So that's where the misconception is of, it's not a detriment of you pulling their report, but it's a benefit. So you know the true score at the level it is for mortgage purposes, and then having access to what can I do to improve or raise that score.
Yeah, you bring up a good point. I mean, there is different types of inquiries too. If I was to go and if I was in the same day, imagine, I'm so savvy because I know nothing about credit. I'm going to get a credit card. I'm also going to go to Anastasia to get a mortgage loan approval. And then why not? I'm going to go to the Porsche dealer because I've been checking out that Porsche for a while. And I'm going to also have the Porsche dealer pull my credit as well. These are three types of inquiries. And then the clients get really freaked out because their credit score could drop as much as 50, 100 points because three of those different types of inquiries get pulled in the same day or a short amount of time. And so then they go back to me and say, Anastasia, you're the one that did it because it's your inquiry that ruined me. So tell me about the different types and why in that scenario, why it's important that when somebody is shopping for a home, that they don't also try to get that Macy's sweet grill deal that you can get for $50 off or whatever. And then also that Tesla that they're fantasizing about getting next year, that they should stick to one type of inquiry at a time. And how much time should they wait before applying for additional lines of credit?
Absolutely. So what Anastasia's tipping on is what is called the shopping clause that is factored in by FICO. So the same industry, the same inquiry is counted as one inquiry for a particular time period. You'll see different factors online talking about a 30-day window. If there's 3-4 mortgage inquiries, it's going to count as one. If there's 3-4 auto inquiries, it's going to count as one. But the key point is, like Anastasia said, if there's different industries, it's going to assume, what if you're getting a mortgage loan? What if you're getting a new auto loan? And what if you're getting a new credit card? How do we factor in now your ability to afford that? So, that's where the inquiry turns into a new trade line, and then the new trade line will season over time. And that's where the scores may drop initially with the reporting of the new account and then replenish themselves over, you made 2, 3, 4 payments. Oh, Anastasia can afford that. Great. We're no longer dinging her score certain points in that questionable, can you afford this new debt?
Yeah, I love that. I love that. And then I know one of the things you and I have worked together with on many, many clients who have in as little as 5 to 7 business days fixed their credit. That's amazing. So what is that process like? A client comes to me, I pull their credit via soft credit pull. So no impact to credit. I now have access to their credit report. And then you know what? I then send the credit report to your team and I say, you know what? This credit report is 648. I need this to be 700. What can we do here? And how does that process work?
No, absolutely. So, Anastasia's special in the sense that if she does see someone and sees an opportunity to strengthen their scores, we have the ability to review that report. We can do scientific analysis that'll tell us the specific actions that they could take to turn a 648 to a 668, 688, maybe even a 748. We don't know. But again, we can look at the report and share those actions with the consumer to say, what is your willingness to maybe spend a particular amount on your credit card balances to increase those scores? Or if we identified an account that does not belong or a delinquency that should not be reported. So as we're looking for what I call out-of-pocket expense to increase scores, sometimes there are non-out-of-pocket expenses, which means we could approach a creditor in a particular way and get a forgiveness of a reported delinquency or a correction to something that shouldn't be there. But the normal reporting process could take 45 to 60 days or longer to get an account to finally update, because if we all understand, the creditors have to update the information on their systems. They then have to get the data to the credit bureaus. They have to update their information before someone like Anastasia accesses that information. We have the ability to shorten that process to 5 to 7 days, and it's specific to the mortgage industry that they allow, which is called a rapid rescore. Comes at a little price, but it's something very beneficial that changes the whole landscape, right, Anastasia, of
Yeah.
someone, and their ability to change their affordability, their difference of a down payment, their difference of mortgage insurance, just by getting that score to a different level to fit the different program.
And Jose is asking you a question. Would that be similar to a rapid rescore and getting a credit supplement?
So a rapid rescore. I was trying to pull the chat up here, but I didn't have the option. So anyway, the difference between a rapid rescore and a supplement. Great pointer, because there's a little misconception there. A supplement is us evidencing to the underwriter there's a reason, a change, or a verified difference on a particular account. So that's cosmetic. It does not impact the score. To have an impact on the score, it needs to be changed at the bureau level. And the only way that happens is through the natural reporting, 45 to 60 days, or the immediate update with a rapid rescore, 5 to 7 days. So when that changes there, because do we all understand your credit score is not attached to your credit report? It's not carrying that credit score around wherever it goes. It's that particular point in time that the report is pulled, that it then funnels through Mr. FICO, I call it, because Fair and Isaiah companies, two real people who developed this technology. The data is funneled through their models at that today, July 17th. And there's your score as of today, which could legitimately change tomorrow if a piece of information gets updated or changed on your credit report.
Awesome. And then one last parting question for you is, share with me opt-out pre-screen, how important it is for consumers, what does it do, and how can they protect against trigger leads?
Anastasia, probably the number one thing that the realtors and yourself and everyone needs to discuss with the consumer today is protecting your privacy. So what happens today is that the fact of an inquiry, whether it's an auto inquiry, a mortgage inquiry, a credit card inquiry, there are people that purchase that information from the bureaus. It's not Anastasia, it's not Vic at Premium Credit Bureau, but the bureaus will sell the fact that, hey, somebody just asked for mortgage money, and they will sell it to other companies, and you will hear your clients pestered. And I just had a phone call today with a guy that said, Vic, we pulled their credit and they have stopped counting right now at 70 phone calls and text messages. So everyone on the call, that first inkling somebody has about wanting a home, wanting a mortgage, they need to visit a site called optoutprescreen.com. OPTOUT prescreen.com is the only true site where an individual can go, check a box to electronically opt out for 5 years so that their privacy is protected and they're not sharing the information of what you may be shopping for.
Awesome, awesome. And then we had one question in the chat, and then we're going to wrap it up. Is, let's say a borrower has a mortgage that gets reassigned to another company and the client hasn't been provided the new company to pay. The company then reports a 30-day late on the first month to the borrower. Can this be remedied?
Absolutely. And I just had that live example yesterday that I was just thumping on with someone, that yes, they were unaware the servicing of their loan was transferred and unaware of who to make that payment to. But that's obviously remaining, you know, intimate with your finances and saying, hey, if my mortgage payment's set up on auto pay and I have an extra $3,000 in my account, why? You know, and making sure that the proper parties and payments are made. Yes, it can be rectified, but again, it's, you know, now you're dealing with two different individuals, the old servicer and the new servicer, and making sure who is the party reporting that delinquency and that they do see the fact of a payment was made, you know, on the account. And hopefully it is made, but even if you have to send that payment to your old servicer, you know,
Yeah.
just make sure that you have that 30-day period from July 1st to July 30th to, you know, ensure a payment is being taken. Because once it gets to August 1st, they could ding you on that 30-day delinquency. So remain active on that. But, you know, that's where you have to be proactive for yourself in that case.
Any last parting questions? I know I had said that I was going to leave time for questions, and I know we're now officially 3 minutes over time, and I want to respect everyone's time here. But any one little question that we can quickly answer before we jump off and go on with our day. And Mindy, question?
No, that was excellent. Very good.
Awesome. Well,
Thank you.
thank you, Vic. That was an amazing, you know, very, very educational. I hope all of you here on the call learned at least a little something about credit. Credit is ever evolving. And so if you ever have any credit questions, I've dropped my email in chat. Again, we do free credit counseling, free, complimentary. It does not cost the client anything. Rapid rescores are something that the lender actually pays for. So I will absorb any client's rapid rescore, you know, cost, you know, depending on the scenario, if it makes sense for me. So I'm happy to help you, any of your credit challenged people. Don't let these people slip through the cracks. These are actual leads. These are people that don't know any better. And just because somebody has credit that, you know, a lot of people think, I pay off my credit cards and then I apply for a home loan. Not necessarily. You don't need to pay off your credit cards to be approved for a mortgage. Let me run the score. Let me identify how much of it is even affecting your mortgage, because sometimes actually not at all. And so don't let these clients continue to wait and not know, you know, their actual credit things. So anyways, thank you. I appreciate it. Vic, thank you for your time, and everyone have a fantastic day.
Thank you for having me. Have a great day.
Thank you.
Good job, Vic.
Take care. Bye-bye.